Welcome to the Clear Skies Retirement Podcast with Jay Kirkwood of Secure Financial Management. My name is Randy Cook, and we're here to talk about you and your retirement. One of these days, you're going to hang it up. You're not going to go into the cubicle anymore. You're not going to drive in 20 minutes, half an hour, hour and a half like my commute. And you don't have to worry about that anymore. But the fact of the matter is, the one thing we do worry about is there enough money once we walk away from our employer? Jay, how are you doing today?
I'm doing really well, Randy. I'm excited for today's show.
Yeah, we've got a lot to do and a lot to talk about. And I know that when we when we talk about people who are our age group, we start thinking about retirement. For some reason, we all start watching financial news, and now all of a sudden we're experts on the Fed and all these different things. So let's talk about it a little bit. We've been waiting for the Fed to change interest rates in their direction for 4 years. They've been raising, and now all of a sudden, here we go. We're starting to lower the rates. And they were kind of aggressive when they started. They did 50 basis points. But does that mean anything? I don't know. That's the question I have for you, Jay. Does this mean anything that interest rates are starting to come down?
Yeah, well, the way it's been hyped up, you would think it means something, right? Mm-hmm. Everybody's been looking forward to this for quite some time to see what the action would be. I will say this to start off with. Let's talk about kind of the rate cut, the decisions behind it. Should they, shouldn't they? And then, does it really mean anything to us in the end, right? I have a feeling they might be regretting making a 50 basis point rate cut. I and many other people thought it would be a 25 point, a quarter point rather than a half point. The logic with that is just, it's much easier to give another rate cut than to have to reverse course, right? And come back and say, if they had to go back into a rate tightening cycle, it would be a mess, right? So anyway, what's done is done. The question that comes up a lot, and I think it's a question you have here as well, Randy, is, okay, 0.5%, like, what does it actually mean, right? Well, all the lending you see, all the borrowing you see, whether it's home loans or autos or whatever it might be, it's really all tied to what's going on with the treasury market, which is the bonds that the treasury issues, right? I've just got to tell you, I don't know if a home, and they usually don't pass on the whole rate cut anyway to the consumer, right? Yeah. So, I don't know if interest rates for mortgages coming down by 0.3% or 0.4, well, let's say the whole 0.5, right? I don't know if it's going to make that much of a difference. Is that going to stimulate things that much? If you're going to buy a vehicle, do you remember, I remember for a long time, I'm sure you remember it as well, 0% financing was just standard.
Yep. Everyday thing.
Hey,
yep.
60 months, 0%. If you weren't getting that, you're like, something's up here, right? This is normal. Well, you don't find too many of those now.
Right.
You're more in the 4, 5, 6, 7, maybe even 8% range. And does an auto loan coming down from 7% to 6.5, is that enough to get you off the sidelines to move? I really don't know. And the second part to that is, if it's me, I'm not looking to buy a new house. I'm not looking to buy a new vehicle right now. I hate that process and having to go through it, right? Yeah. But if I was, I think also what I might be thinking is, well, wait a second, maybe there's more of these coming and I should hold off before I do something. And so, I think you've got a lot of opposing forces there.
Yeah, you think about if they slow roll it like that, if they do 25 basis points for the next 6 months, if you were wanting to buy, I'm in the market to buy a car, not a house, but in a car, why would I buy at 6.5% when I could wait for a little while and go at 5.5%? That makes total sense. All right.
Yeah.
So
absolutely.
Then the other part of it that you and I talk about here is, how does this affect people who are planning for retirement? One of the things that we've talked about over the last year or so, as interest rates go up, bonds don't look so good. When interest rates start coming down, bonds look a little better. This is Carrie Hannon talking to the people at Yahoo Finance saying, we may need to rethink the way we plan for retirement because bonds are starting to look a little bit better.
What happens is, as interest rates drop, bond prices tend to rise. In fact, there are some really good opportunities for people to start looking towards bonds once again, because there have been 2 dismal years of bond prices as interest rates have been high. But as they start to come down, we will see some opportunities here. Maybe rebalancing their accounts a little bit, moving a little bit more into bonds, particularly if a sort of twitchy stock market makes you nervous.
All right. So let's talk about that a little bit. Does this kind of like have you looking at the people in the office going, stop the presses, we're changing direction? Or is this kind of just like, okay, let's just move over here?
Yeah, she gives a great analogy, high level, kind of what the relationship to interest rates and bonds are. Let's talk about that for a second.
Sure.
And let's talk about, is there a strategy shift going on here? And the one thing that I think is the most important thing to consider, and I will do that at the end. 2022 was a very valuable and for some people painful lesson in not understanding how investments work and how your investments work. And you don't have to be a PhD level investment analyst to understand, just having a basic knowledge, right? Because she mentioned, hey, it's been kind of rough for bonds recently, the last couple of years. It's because interest rates are going up. And if you hear that, you're like, all right, well, that's how it works. But why does it work that way? I think it's important to understand that. Well, this is a thing, Randy. If I issue you a Clear Skies Retirement Radio bond, okay, and bonds are issued in units of $1,000, and I'm like, hey, I'm going to pay you 3%. We're 3 or 4 years ago, right? And that was pretty standard for a bond. I'm going to pay you 3%. Well, fast forward during rate cuts, and you've still got that bond, and I'm paying you your 3% on that. And well, interest rates have gone up, and I'm going to issue another bond. No one's going to buy that bond if I'm only paying 3%. I've got to pay 5, 6, 7% because that's what the market's paying.
There you go.
So you now own a bond that's paying 3% when the new ones are making 6%. Who's going to want to buy your bond?
Nobody.
Right? That's why they lose value. And it works the opposite way as rates come down. We ran across many people that came into the office in that 22, early 23 timeframe that had just about 100% of their portfolio in bonds.
Wow.
And they just had it there forever. And the mindset was, and unless you kind of educate yourself on this, right, you're going to think this. The mindset was like, well, yeah, the return's not that great, but I don't have any risk. Well, 2022 showed you that you do have risk because a lot of those portfolios were down about 15% or so. So I think this highlights the importance of knowing what's going on in your portfolio. Maybe you don't want to manage it. That's why people come to us. Maybe you don't want to have a second job in retirement of like managing your money, right? You want to outsource that. But ask for a kind of an explanation of why are we doing this and why are we allocated the way we are? And what are the risks that I face in the different sort of allocations that I have? I think that's the first point.
So then the other part is there are certain financial products that we're going to use in retirement that are dependent on interest rates, CDs, bonds, annuities, money markets, things like that. And this is the area that's affected by these interest rates. So how do we deal with that?
Yeah, so it's still planning out what is your strategy for that more conservative part of your portfolio. And the big thing that is going to be a pain point for people soon is that there's a lot of cash out there in money markets, in CDs, short kind of term duration things that have very little to no risk, right? And you've been getting 5+% on those up until now, right? So what's the plan when you're not getting 5% in that money market and you're getting 3%? When you're not getting 3% and you're down to 1%? Where are you going to go? It's a temporary solution.
Now that pushes people, and we saw this when interest rates were so low, it pushed everybody into the market. There's no yield anywhere. I can't get anything for my money, so I push it all at risk. And that's not where the retiree wants to be, is it?
It's not. The reason people did that is they didn't think they had an alternative.
Okay.
They thought, this is all I can do. We're talking about a time when savings accounts or money markets would pay you 0.01%, not even 0.1%, 0.01%.
Wow.
Let's just call it nothing, right?
Yeah.
Basically, is what you're being paid. So you look around, and if the only kind of lens you're looking through is, I've got to be in the markets, or I've got to be in a savings account, or I've got to be in bonds, well, then you look at that option and say, well, what else can I do? When the truth is that there's other things out there that if you go and meet with a comprehensive certified financial planner, they're going to be able to give you some options.
Well, that's what you should be kind of asking yourself. If you're following financial news and you see these things happen, you say, okay, so how does this affect me and what do I do? And if you don't know, That's the reason you sit down with Jay and the team at Secure Financial Management. There are options out there. If you're uncomfortable with the market, you don't like the risk, you're going into retirement, and you say, what else is there for me? Let Jay show you some of the things that are there. And right now, interest rates are coming down slowly. It's not like it's all going away. It's not falling like a rock. It's falling like a feather. So let's take advantage of it while the opportunity is there. Check us out online at retire210.com. That's retire210.com. And if you've enjoyed this podcast and you want to hear more, hit that follow or subscribe button on your favorite podcast platform. And again, thanks for listening to the Clear Skies Retirement Podcast, and we'll see you next time.
Investment advisory services offered through investment advisory representatives at Secure Financial Management, a registered investment advisor. Exposure to ideas and financial vehicles discussed are not designed nor intended to be applicable to any person's individual circumstances. It should not be considered as investment advice, nor does it constitute a recommendation that anyone engage in or refrain from a particular course of action. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Secure Financial Management is licensed in your state, please contact their office. Secure Financial Management is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Wholesalers Insurance. Jamin J. Kirkwood, Texas Insurance License number 1421850.